All right, welcome back to another Stock Talk live stream. How's it going, guys? We got BaconMemes here with us today. How's it going?
It's going. It's going. How are you doing, Jesse?
I'm doing good. I'm doing good. It is hot. It is hot in Washington right now. Well, for
Uh,
me, I think it was like 97 or 98. I saw 99 briefly and I was like, that's nah. I'm good. I don't need any of that in my life. So I am in the basement as always, where it's a bit cooler at right now. So
Very nice.
yeah, but at least I'm not in like Texas, right? So
Yeah, it's miserable.
uh,
That definitely, yeah.
yeah, it's pretty bad there. But we got a couple Discord requests. Let me pull it up real quick just to see where we are. But I think we had American Express,
Yep.
Discover.
Yep.
Um, what was it on those shoes, right?
Huh.
Somebody
Uh,
put the on ticker. I
I
want to
didn't
say.
catch that.
Yeah, man. So I don't know if we're gonna get to that today, but somebody
Oh
put
yeah.
that. We got Estau, the classic
Yep.
Estau. Um, and yeah, so we'll get into it, and then we might talk some. Well, I think you're gonna talk about the UFC WWE merger because I think
Yep.
you have a lot more maybe insight or maybe just random thoughts
No.
on that than I
No.
do.
Yeah. I was gonna say my insight on that is pretty minimal. So
Insights with Bacon.
yeah.
Welcome back to Insights with Bacon.
Oh
We
jeez.
got Bacon. He's going to tell us all about how you can get wrecked with WWE and UFC.
Yeah. It's. So it's an interesting one though because I don't know what reasonable growth like assumptions to attach to this. And I don't to credit like to the companies over there. I believe the current CEO of Endeavor, the guys that own UFC, they're the CEO for this merger is still going to be the person from Endeavor going to be the CEO for the merged company, whereas Vince McMahon, the head honcho over at WWE, or at least majority shareholder, chief executive, or not chief executive, uh, the chair of the board will be executive chair of the board for the merged companies as well. There's a lot of
Hmm.
nuance. Yeah, they're gonna call themselves TKO. Ticker will be TKO, I believe. I think historically, like when it comes to the track record,
TKO.
yeah, they're gonna base it off of
That's good.
WWE's. Um,
Yeah.
the problem is that, and I haven't seen any like clear details yet, but I believe like people that own Endeavor stock will be able to get like a one-time special dividend, so there's a lot of things to be excited about for sure, but some things to be hesitant with. And frankly, like I tried to do some due diligence, like with less than 24 hours, but I got more questions than answers. And I guess like one metric and some accounts to look forward to for financial statements would be like COGS, like any sort of SG&A expense. Like you would want to see those in theory uh, be tame or go down relative to growth, especially because the things that like I was able to pick up was hey, we're going to merge. We may not necessarily like we're slash employee costs and all that, but there should be some like hardwares, or rather some infrastructure that we can make optimized, make efficient. And I hear that, I think to myself, okay, well then that should translate to some sort of expenses being reduced going
Yeah.
forward, especially with scale or as things scale.
Now
In
is
theory.
is either is either side publicly traded right now?
Yes, yes, I did confirm. WWE is the same ticker, WWE, and Endeavor is EDR. I want to say for their publicly traded stock. Yeah,
Okay.
it'll be interesting. Like in theory, it sounds
And
it sounds
WWE is
okay
on a
enough.
tear lately.
Oh yeah, yeah. Uh, in theory, it sounds okay enough. Like if Vince McMahon still like runs WWE's day-to-day operations with an iron fist like he did back in the day, um, he produced an okay enough product ish. Like there were
Hmm.
moments where it was spotty, but I yeah, I don't foresee that being crazy bad. I mean, he does own a lot of shares. He will own a lot of shares, and he does have some serious charges levied against him. So we'll see if that's anything going forward. But I think I gave enough of a cursory glance to say, okay, here's some financial details to look at going forward, and just be cautious as far as what you own and who gets burned over how. These things can be exciting, but they can not be so hot for people, just rushing in. Um, yeah. I don't know. Anything that stands out to you? Um,
I have no idea.
okay.
I haven't really been following this at all. So
No,
like
it's
somebody
it's
brought
all
it
good.
up and I was like, LOL, like,
It's
Bacon
it's
can
all
take
good.
it if he wants, and I haven't looked at this at all. So
It's all good.
yeah,
Like
I'm
like I
probably
know
gonna
I know that
TKO
there's
people's brokerage accounts.
I know that there's like one other like fun little detail or nuance being what's it called? The TV rights. Like historically, WWE has been doing pretty well at negotiating those. We'll see if that trend keeps up going forward. Maybe this merger helps if they still have TV rights to negotiate. Because I want to say, last I heard was they're still under negotiations.
Yeah.
Again, I could be out of date with that though.
Well, I mean, just on like for WWE, at least, I mean, their margins have been improving over the last 10 years or so. So it looks like they
Yeah,
have like steadily seen some decent, more like just bottom line margin improvement. Gross margins isn't too crazy, maybe up a little bit over the last 10 years, but
yeah.
bottom line seems like they've probably pumped out some decent efficiencies there. Um, yeah, yeah, I don't know. I don't know about the valuation or anything, but it's pretty
Yeah,
interesting. So we
neither
got
do
like
I.
what? Yeah, I don't know.
Yeah,
I don't know.
so
But
it's
it'll be fun. It'll be fun to see how it plays out. Yeah, I mean, what's it trading at right now? What are the yields on it? So shoot, free cash flow yield, 2.474% for EBIT yield, net yield 1.89. I mean, that's like really, really, really expensive. It's PE 56. Dang, I don't know, man. That's pretty crazy. But so I'm guessing a lot of this was just probably some improvement fundamentals, but a lot of multiple expansion on the last like 3 years or 4 years. Uh, Um, yeah, we'll see. We'll see what
mhm.
happens with it. But the fun one that everybody's having fun with right now
Oh
uh,
yeah.
is all from our most favorite YouTuber out there, who is a genius. PayPal stock is down a whopping 6% today. I don't I don't know. It's a skill, man. It's a gift. It's a gift. Um, and I know. I think yeah, Fabio from Capital Mindset just put another video out on this. I have one video out on PayPal from like almost a year ago, I think.
Yeah.
And initially, my thought was like, probably high 60s, and back in like this is probably like 2022 ish.
Mhm.
When it started this nice downtrend, I was thinking like high 60s. I was in it briefly. I actually was in it briefly. I think I got in like around 72, 75, and I ended up taking it
Oh,
off around like 95 or 100. Like,
winner.
um, I it yeah, I got lucky, and it wasn't a huge position, but I took it off just because I like the GPN more, so I kept that position, and now it's it's down to $59, which it's I will not lie, it's getting interesting. It is getting interesting again.
Uh,
Um, I've run some numbers on it briefly here and there. I just don't know. I don't know how they're going to kind of be able to manage over the next several years as they kind of get crushed potentially with margins. Like, so what I would want to see from PayPal,
Mhm.
and they already kind of started doing this because they divested their or they're selling off their buy now pay later stuff. So
I believe
that's
so.
good.
Yeah.
Yeah, I I in these type of environments where it's kind of like a race to the bottom.
Yep.
Um, I want to see the company that is like gaining the most amount of efficiencies and is like squeezing people out because they have so much like operational uh, margin and they're able to really control kind of like that market. That was pretty much my thesis with Cigna Group on the Express Script side was they did the Express Scripts acquisition. It's done all right so far, but they're really focused on generics and like operating efficiencies, production
Mhm.
efficiencies, and essentially being the one to squeeze other players out, right? So um, PayPal, I kind of sees the same thing. Is like, can they get to where maybe their white label or their product offerings are really I would say like super competitive to where they're the ones that are helping squeeze other players out. Um, because if they don't do that, they're just going to end up being the ones getting squeezed
Squeezed.
out,
Yeah.
right? So
Yeah.
that's what I think is pretty interesting. The CEO change, I think it's going to take a minute for the market to digest that. But we'll see. We'll see what happens. I mean, they are. We can do a quick eval on them right now.
Mhm.
Like they are arguably getting cheap. Like I think their EBIT yield is about 7.65% right now. Net
Yep.
yield 6.15. Free cash flow yield of 5.15, and they're expecting a recovery in free cash flow, I believe, over the next 12 months, back up to I want to say it's 5 billion. So when I plugged this in, I'm going to do a adjustment to kind of adjust that free cash flow back up to the normalized state before we project out the growth.
Mhm.
Um, so manual adjustment, yes. Um, and it gets interesting. They do have the ability to buy back shares, and they have been buying back more shares lately.
Mhm.
So let me zoom in a little bit on this for people on the YouTubes, so you guys can see. So they have been buying back a little bit more shares lately, about 3.8% buybacks or reduction in outstanding shares over the last year, I believe. So we could like probably give them a little bit better buyback margins going into the future or buybacks going into the futures. Because if they're yielding, I mean, if they're yielding like 7-8% to their bottom line, that's going to be attractive area to buy back. So as long as their cash flow is strong and they don't need that capital to reinvest, or they have more than enough capital to help to fulfill their R&D, they'll probably do opportunistic buybacks, I think. I don't believe they pay a dividend. They're not really a dividend payer. They're more of just a share repurchaser. So yeah, it's getting interesting. So fair value yields, I think you could be argued that probably fair value yields are historically going to be between maybe like 3.75% and 6%, something like that.
Yeah.
And I think in the like 5-year term, like in 5 years, their multiple is going to be highly dependent on how the market perceives them in their sector as like how strong of a player they are, right? If the market thinks PayPal has a lot of, power and kind of operating efficiencies that they can drive margins tighter and kind of steal market share,
Yeah.
then they're going to obviously have a way better multiple than if the market's like, oh, PayPal is just this like one off, like isn't that good in their marketplace. And like there's other premium players out there. So I think what I'd do is probably somewhere between like 3.5 and like 6% on the multiple side is probably what I'd give them on the scenarios. And then that pretty much gets us to, it's definitely in the base case, I would say. Growth 6.5 to 12% is what I would expect. I think they can grow at like 10%, even if they aren't like the top player. We could just get into a situation where maybe they grow at 10%, but they don't get the multiple assigned to them by the market because they're like, not the best player in the sector, which that's pretty, I think that could be pretty likely. But yeah, bottom line growth 6.5 to 12.45. And let's see, base case, what would that give us? Base case, that would give us around between net income, EBIT, and free cash flow, probably around 6 to 7.8 billion after 5 years. And yeah, I think that's doable, man. That's doable. If they didn't do that, that would suck. It's funny because it should be fairly easy for them to hit those type of growth rates, especially if they just see a little bit of margin improvement. We got top line or gross margins has been compressing for a decent amount of time, but their bottom line margins have stayed relatively stable, maybe dipped recently a bit, but they've been maintaining their bottom line margins pretty well. So yeah, $67 base case, 54 or 44, and then obviously that'd be higher if you wanted like a 20% return. So 20% return, we're pretty much getting right into the base case right now. But yeah, I mean, it's interesting. So by this, fair value would probably be anywhere between 64 to $85. So I think you could argue that it's discounted maybe a little bit below fair value right now, or at, reasonably it's at fair value. So I don't know. Do you have any thoughts on it? What do you think about PayPal in general? Is this something you would consider? Something you're interested in?
It's not, but the immediate question that I had, and maybe this is me being a bit of a knee jerky, but I see the purple on that Reuters link, Elliott Investment, having pulled out. What are your thoughts on that? Or is that net positive or net negative? Because I can see arguments for both. I can argue for both sides on that. But
So
I
what
want to hear
was
your thoughts.
I always get paywalled on these things.
Oh,
But
okay.
what was their reasoning? Were they just
I didn't see. Yeah, I didn't get that far on that.
I think so. I don't know. I typically ignore a lot of super investors or Elliott investments or whatever, because you don't know their reasoning, Now, if they're coming up with a short thesis and they're like, hey, we're getting out of
Short
this name because
or
of all of these different reasons, and we're gonna short the stock or something. I don't know. There's information that I would take with a grain of salt, but I don't know. At the end of the day, I feel like I want to rely more on my analysis and my conviction than somebody else's. Although I still want to, at the same time, take other people's opinions into consideration, but you have to be very careful about that because that depends on who it is. Right. And oh man, if you're taking certain people's opinions into consideration, that are maybe heavily biased or something like that, or just they suck in general, you could be buying at 130 and and you could be down 50% right now. So PayPal is down 80%
bigly.
from all-time highs. So I mean, it's got to be a good deal, right? Gotta be.
Your co-host over in the Exit Liquidity Pod wants us to say it. Your grandpa's fintech.
Grandpa's
No, well, like,
fintech.
all right. So like, here's one of the funny things though, and not to talk my own book here, but like full disclosure, I think we're in an interesting like time frame here that is hard to hard to work with and reconcile because like I've owned overstock, and I'm not saying people should go YOLO into overstock or this or that. It's your money, be responsible with it. But like overstock came out roughly the same time as Amazon, and not including the most recent actions of overstock. Uh, like some would say, like absolutely horrible brand up until they bought like the IP and the branding of Bed Bath and Beyond. That
Yeah.
and like it wasn't really like that long ago in the grand scheme of things. Like General Electric's been around for how many decades?
Yeah.
So like we're getting all these like tech names that are starting to mature, and how they mature will be really really interesting to see, as far as if these are mature possible value plays, if there's possible growth still to be found and tapped into with these. Again, I don't know, but it sure will be fun and interesting times going forward for people that like learning.
Yeah.
um yeah. So it's
Well,
I'm not saying it's impossible, but for me, still too hesitant.
still too hesitant
Yeah,
to go all in on
yeah,
PayPal.
yeah. Yeah,
Oh man.
like Elliot leaving because I believe they have background in activist investing. So like I'm not gonna like hype up activist investors or not. Like if you own a company, Jesse, and I'm an activist shareholder, I'm gonna say, all right, we're gonna do a hostile takeover. And your YouTube viewers are also shareholders. They could be like, yeah, you know what, Jesse's been doing bad. Let's vote with this guy. And you're like, wait a minute. Like, here, BaconMemes. Here's green mail. Here's a standstill agreement. Here's some cash. Leave me alone. And then I leave you alone for X amount of years. Like that burns over the shareholders, and the activist investor gets their way. So that was one bearish thing
Yeah.
if Elliott stuck around. But maybe Elliott was right about the points that they had. I don't know if they made any or not. But I mean, they're gone now,
Yeah.
so moot point.
All I can see all I can see is that their filings came out and like they no longer held it. It
Yeah,
looks like.
yeah.
So I don't know if they gave a reason.
Mhm.
Um and these are like just theoretically, right? They could have gotten out, like 3 days after their last filing, right?
Yeah.
And it was because, there was uncertainty around the CEO. And then the
Mhm.
CEO gets announced yesterday, right? And
Yep.
then their filing comes out today and everybody goes, "Oh my god, they're out of
Yep.
it." And then now that the CEO is announced, maybe they like the CEO or something like that, have a different, opinion
Yeah.
of the leadership and they buy back in. You don't know. Like
Mhm. Oh
a
yeah,
lot of
yeah,
times
yeah,
you just don't know.
for
Um
sure.
but it makes for great clicks and news, right?
For sure.
And drama, because that is what finance news is about, is drama. If you can get people to click, and you know that's that's how you can grow. So but man, yeah, I don't know. I think there could be opportunity in PayPal.
Mhm.
um I think it could take a little bit of time to see how it plays out, but also like it's not like their fundamentals are nasty right now. Like it is arguably very cheap. So I think like the market has a lot of uncertainty priced in, a lot of like margin compression priced in, a lot of, doubt as far as how well they're going to be able to sustain probably their current margins in a highly competitive environment going forward.
Yeah.
Um, and unfortunately, I'm just not an expert in this space. So, and from what I've gathered from people that have more knowledge in it, there are probably much better options out there.
Yeah.
Now, a lot of times those better options, as far as from the consumer side, you look at the stock and the stock is ridiculously overpriced, right? So it's like, pick your poison, because if it does turn around, right, and the market perceives their margins to be a lot more stable, them to have a lot more of an edge in their space, and they prove stuff out, and a higher premium gets associated to them. I mean, yeah, like, they could go up pretty nicely. But even even in my best case scenario, I still don't have them getting back to their all-time high after 5 years. So, yeah, I mean, yeah, under these scenarios, your 5-year target's 102 in the very bearish case, 125 in the bearish, 154 in the base case, 193 in the bullish, and 246 in the variable bullish. But like, there are those like off chances that maybe they actually just get completely crushed.
Yeah.
I don't know. You got to be very knowledgeable in the space, I think, to have a good understanding, or a high probability of understanding what is going to actually take place in the next 5 years for them. I don't know. We'll see. But with all that being said, I'm keeping an eye on it. I would not be shocked. Don't be shocked if it ends up in my portfolio.
Treasure pandas of the world unite.
No, I just like, yeah. 'Cause, I mean, at some point, like, if PayPal opens up tomorrow at like $30,
Yeah.
it's like, okay, it's yielding like 12-14% to the bottom line. That's just stupid. Even if you have a slow dying off business over the next 10 years, you're probably going to recoup your capital and then some on top of that. Assuming nothing drastic happens right away, right? But yeah, I don't know. It is intriguing me, but I'm just enjoying watching it go down at this point. Like, oh man. So we did have what were the others that got brought up? We got
ones that people mistakenly
AXE?
compare. Yeah. There's that the Discover Financial Services one.
Yep.
Someone actually mentioned a hotel related company.
Okay.
Yeah.
Well, let's look at AXP and Discover, because they're kind of in the same. Not really. They're not really in the same line as PayPal at all. But some people might think they are. So,
who are those some people?
Trash Panda Gang. That is right, man. Trash Panda Gang.
Treasure pandas.
And we treasure pandas. There we go.
Yeah.
I'm interested in DFS. Okay, we'll take a look at that one.
Yeah.
PayPal is basically JPM.
You know what? I will say this much: if like Jamie Dimon somehow, or like somehow, like the CEO of,
can we rebrand to Diamond Pal?
Oh god. Stream gets derailed by chat. I love it.
Oh my gosh, I love it too. I'm trying to be a little bit more interactive with the audience lately. What's going on, Kingdom? How's it going, man? But it can be hard when you're trying to live stream, talk about stuff, and also keep an eye on comments and stuff like that. So I gotta randomly, pull up some comments here and there. Oh god, that's funny, man. Kingdom, don't leave us, man. Don't do it, okay?
Yeah. Exit Liquidity Podcast still needs.
Yeah,
still needs the boys.
We still need your exit liquidity. I mean,
dang! There goes the moving bus. Yeet!
I'm just kidding. And I love you. I love you. All right, so AXP. Let's get back on topic. So American Express. Let's see. I went through like a little bit of American Express, but not a ton. Honestly, super surface level. Let's probably just go over the financials and numbers at first, and we can just get a feel for it, and then maybe dig through the investor presentation, because I know somebody wants to go over Discover. So I want to make sure we get to that. So American Express has also been on a nice I don't know, it's been channeling. So it's been not a huge downtrend. It was DFS that got whacked, man. DFS got hit hard. Actually, we might do DFS first. Because they have compliance issues now. And did the CEO leave? Like, something happened. It's down like 10% today.
Well,
and yeah, so CEO exited. I think the SEC is investigating them for compliance issues. Like, there's some drama. There's some trash going on with this one right now. But so we can look at this, but just briefly going over kind of their investor presentation and stuff. Like, a lot of these, well, Discover, I look more at kind of their loan book too, because they do have a pretty significant amount of loans. If we look at, I might be able to find it here somewhere. Let's see, total loans, 118 billion in loans. And they even gave a little bit of a breakdown in their investor presentation as far as the loan breakdown, and a lot of it's like personal loans, credit cards, stuff like that. So it's just like you're buying, you're buying like a bank essentially, right? And you're buying a bank with like a pretty, like, I don't know, probably a lower quality book. So yeah, here we go. So credit card loans, credit card loans, 93. I'm guessing that's billion. Yeah. So 93 billion in credit card loans. That is, oh my God, that's a lot. So year over year, that's up 18.6%. Student loans, 10 billion. Personal loans, 9 billion. I can't really, I didn't really see anything as far as the like credit worthiness or the like average weighted credit score of their loan book. That might be somewhere else, but yeah. So when we look at Discover on the valuation template, we got to really keep in mind that this thing is being priced and risked as a bank with probably a pretty crappy book, right? Which, yeah, I would agree. And man, but dude, look at the decline into 2020, like how much this went down. It was insane, right? And you're like, oh, it kind of had a nice recovery, but like it was down 70%.
Yes.
It was down 70% at the bottom, and from the bottom to the peak, the recovery was maddening. It was like 430% recovery. Like, holy crap.
Eat your heart out, tech.
I know. Well, I mean, maybe the market was like, everybody's going to die and their loans are just going to be forgiven. Crap. Well, and we were going through deferments and stuff, not deferments, but yeah, the whole like rental deferments or whatever, all that stuff. So yeah, I can see why the market would freak out that much for it, but holy cow, man, 70% down. Yeah, that was insane. So DFS, let's just dig into it. Like, the bottom line yields you can see have been kind of like all over the place, and since it's a bank, we can, well, since they have a very large book, kind of go off of net yield. Net yield right now is at 16.65%, which is crazy. So it's but I guess if we looked at probably enterprise value, what's their enterprise value compared to the market cap? Because after we account for that debt, could explain a decent amount of it. So is it under? No, I think it's here. No. Enterprise value. It's not that bad. But anyway, we can see their basically long-term debt here is pretty insane. About 20 billion. Is that right? Which is interesting because didn't they had over 100 billion in notes, right? So maybe that isn't counted as long-term debt for them. Probably not, right? So, but going over to the template, like if we do a net income only valuation, and we can kind of see that the net yields probably range between maybe like, we'll say like 8% to maybe 14% and try to get into that range. So 8 to 14. And we can probably do like -3. 8.77 to 15, right around there probably. No, we're not going to know that much. That much for multiple. 3.5. Yeah, something like that. So 8.2 to 14.47. So just based off of like historical multiples, and this is a 2.69% dividend. So really, if we're doing like 12.5, so target price CAGR 15%, 2.69% dividend. I mean, it looks like fairly cheap. You should check out their buybacks, man. Oh my gosh, look at this. They have been buying back shares like crazy this last year or two. So they are a serial buyback machine, which I like. I just, man, there is a lot of risk baked into the multiple for their book. And I don't know how to like assess that very well. Because it could, if we go through like a worse recession, right? Like what's the first thing that people are like not gonna pay, right? Even when it comes to their debts, credit cards, right? And that's like 90% of their book, or what, 80% of their book. So 80 billion in credit card debt. Like that's basically all they do. So you're acquiring a lot of credit card debt, and a lot of risk for having that much credit card debt on their book. But so I don't think you're never going to see this trade, I think, at a high premium or anything like that. I think it's always it could potentially always trade cheap. But if it always trades cheap and they're always able to buy back a ridiculous amount of shares and they don't go belly ups because of some, I don't know, crazy recession and or everybody dies, but they're going to be subjected to way more defaults, way more write-offs on their credit book. And I think, I mean, that's what the market, I think, has been pricing in for a very long time. So while it looks cheap, I will say I think it's cheap for very valid reasons. It might be overly cheap for very valid reasons right now, but I still think historically it's been very cheap for very valid reasons.
I'm just wondering, and I'm actually going to open this one up to the chat as well as people listening to the recording version of this. What are the tools that people use to try and analyze financial service companies and their book and the quality of their loan books? Because based off of me trying to listen in on banking or just financial service experts or people that are really in this space, they've admitted many times that, like, hey, it's real easy to get blindsided, real easy to get caught off sides, real easy to have things get blown up in your face if this is all you do. And that just like for me, like it just like discourages me even more. So I don't know if there are any good research tools or sources that people really stand by, but feel free to throw them at me. I think there might be some people out there that don't know and would like to learn.
That would be interesting. I wonder, like, if you could. Well, I mean, it would be really hard, right? Because you would basically have to take every single bank on a case by case basis. I
Yeah,
don't know if you could just scrape that data,
yeah,
but there might be services that scrape those filings for you to try to come out with
mhm,
different measurements of the loan book. Um, Maybe easily like put it. That'd be kind of nice. Put in a ticker, and you could see like
yep,
the breakdown of their entire loan book, like
yeah,
the average FICO score of every single section,
mhm,
um, whether it's like auto, mortgage, personal, credit card,
mhm,
um, maybe different leverage ratios. Uh, yeah, that'd be kind of interesting.
yep,
There's got to be something out there. Um, Probably not available to retail traders or retail investors, right? I'm sure like I'm sure funds have really, really good tools available to them. I don't know. But I bet you might be able to put some type of tool together that would scrape that kind of data.
yeah,
It might just be it's just gonna be harder because it's not like a standard like uh
yep,
stock or like financial metric, right?
yeah.
It's really a qualitative or like a quality aspect of the company.
Some might say
Um,
we're venturing a little bit closer to alternative data at that point.
yeah, yeah, whatever, whatever.
Yeah,
Um, because man, I am like, at least for like going briefly over stuff, I'm lazy, man.
yeah,
I don't want to pull up tons of information to get a brief view. Um, I'm usually like, that's why I created this thing because I'm like,
mhm,
I can put in a ticker and I can see anything that I want. Like I'll just
yep,
create a graph for it, and I can see all the ratios, the metrics that I want, the growth, all the specific information that I want that's available. I can look at it really quick, do a super surface level horrible valuation on it, and decide if I want to go further. Right?
yeah, yeah,
Um, do you own FIS? I do. Um, so my two stocks for the payment space is FIS and GPN, so Fidelity
ah,
Information Services
yep,
and Global Payments Network. Um, and I'm FIS is the smaller allocation. GPN is slightly larger, about 30-40% larger. And then it's also up a decent amount as well. So I think I'm down a bit on FIS. Um, I arguably I think um, FIS is still cheap, but it's still cheap for a reason. They're trying to divest a bunch of they're basically trying to undo the acquisition of WorldPay that they did because they're like, whoa, guys, sorry, we suck. Uh, let's let's wind that back. And
M&A.
well, my bad. And it was funny because actually there were some articles that were criticizing FIS of
Yeah.
doing horrible acquisitions, and they actually pointed to my other holding, GPN, as the company that did really good acquisitions. They're like, FIS sucks, horrible acquisitions, but GPN did them really well. So it's not like an acquisition issue. It's just like they're bad at it. I was like, yeah, but I didn't buy FIS until like I don't know, $60 or something like that. So I'm down a bit on it. I want to say I'm down like 8 or 10%
It
on
could be worse,
FIS.
especially
It's
especially for
honestly not that bad. Like
yeah,
I expect oh stock.
yeah, like
Usually when I'm accumulating something, I expect to potentially be down, you know, a decent amount at times. But
Who
that
amongst
also, go ahead.
I was gonna say, who amongst Treasure Panda investors haven't been down like 50 or 75% unrealized here and there?
Well, dude, I think on Meta at one point I was down like 30-40%. Like when it
Very
was like at
nice.
$90.
Yeah.
Um I mean, I wasn't technically down that much for long because I bought a buttload then, but so my average cost went way down. But yeah, just because of my accumulation structure, like if I'm gonna like, let's just say I'm going off of this accumulation structure right here.
Mhm.
Well, I'd be buying at like 118, and then I'd
Yep.
be buying at 95, then
Yeah.
I'd be buying around 70 or
Mhm.
77 to 70 or something like that. So like
Yeah.
just in my accumulation structure, like, I'm almost building in for an additional 40% downside.
Yeah.
Um, just because that's how I do it. Because I mean the market is generally good at valuing companies and having being efficient, but at times, we have these panic sell-offs and stuff, and that can be due to market reasons, sector reasons, company reasons, and you can see pretty steep discounts. Now, whether
Yeah.
those discounts are opportunities or not, that's another question, and you
Mhm.
don't really know until it's either obviously a horrible investment or it's a lot better. But I've found that many times, like it I've been doing this style for like, I don't know, like a year and a half now, something like
Yeah.
that, but really focusing on it for like a year, I would say. um and it just seems like the more that I stick to like my quantitative analysis with the qualitative factors, and I stick to that methodology, and I use reasonable valuation factors. Um, it seems like whenever I do buy, like recently, there's been a lot less risk of me being down, a ridiculous
Mhm.
amount. Just because at some point, like cash flow is cash flow. If the
Yeah.
cash flow is super cheap, um, you know, that's going to attract large money
Mhm.
eventually. Especially if the cash flow is super cheap because they think of, say, X reason, but then they realize that X reason isn't valid. Then that's going to readjust pretty quick. So,
Yeah.
and PayPal could be getting there. I don't know. It's kind of on that edge, like, oh man. But I will say also with that strategy, it's almost like, especially when you're looking at turnarounds, you have to be very decisive and like quick if something happens where it's critically different to your fundamental thesis, right?
Yeah.
Because if it changes and it breaks your entire thesis, then like, why mess with that anymore? You're just asking to get hurt at that point. But anyway, Crocs, BOGO.
Oh,
What
good
do you
old
got?
Crocs. Good old Crocs.
Crocs. Thoughts on
Yeah.
Crocs? Um, I got some thoughts. I don't know.
Comfy.
What are your thoughts, Bacon?
Uh, if I could have one of them, like, very nice.
That's right.
This is getting screen captured,
Come
right?
on.
This is getting like recorded. Look, you should have like advertised them even more, but like they're on my feet, no hands. Uh, all right, so yeah, not gonna lie, like with Crocs, it's uh, despite very recent stuff, if I could have a do over for me reattempting to get into active stock selection, Crocs is one that I wish I could do over again. I
Yeah.
screwed up my entry. I probably screwed up my exit, but at the end of the day, like it was profitable, but still got to look at yourself. And criticize what you could do better next time. And yeah, Crocs probably still a great company. I don't know where it is at right now, just because every time I glance at it, I just feel disgusted with myself.
You might get another shot, man. It's back under 100.
Oh, really? Very
Yeah, I
nice. Very
think
cool.
it's at 98 or 97.
Oh,
So 97.80,
yeah.
man.
Yep.
So keep an eye on it.
Yeah.
Yeah, I mean, I've done multiple Crocs videos. I think I did my initial Crocs analysis, and then I did an updated Crocs video. I believe. I don't know. But I mean, so yeah, man. Crocs is also one of those that I think the market is expecting a major, like maybe shift in trend of their product. The latest earnings release, I don't think the market liked the slowdown in the Hey Dude brand growth. So I think they're getting punished for potentially that Hey Dude acquisition, like disappointing a little bit.
Mm,
As far as the top line growth, which is funny because you look at Crocs's bottom line and they're actually
better bottom line.
recovering their margins from the Hey Dude. Yeah, they're recovering their margins from the Hey Dude acquisition better than I thought. And no, they're not going to grow at bottom line at 90%. Let's go ahead and change that. 80, 75, something like that. So it is like one that is potentially very cheap.
Yeah.
And they have a lot of resources to let's see, what am I doing here? They could have a lot of cash flow to essentially buy back a lot of shares. They've gotten their debt back down under 2 billion, so that's good.
Mm,
Their bottom line growth has been fantastic. They've had a lot of really good success with gaining a lot of operational efficiencies to increase their bottom line margins. You can kind of see right here the dip in bottom line margins after they did the Hey Dude acquisition, and then we're already seeing these margins start to recover from both
yep.
a gross and a net operating and free cash flow margin side. So they've done a really good job at being able to place their factories in areas that are fairly close to where the product needs to be distributed. So they've been able to really save on a lot of like transit, like shipping costs, which is funny because like the shipping fiasco, freight fiasco of 2020, 2021,
Yeah.
they weren't nearly as impacted by that as a lot of other companies, that were shipping their vegetables from Italy to America. So,
Oh, well. If you don't know,
so
if you didn't catch that reference, join the Discord. If you did catch that reference and you're not in the Discord, get in the Discord. I got
so
it.
so they've been buying back shares. They put a pause on their share buybacks to tackle their debt from the Hey Dude acquisition.
Yeah.
The nice thing about the Hey Dude acquisition is they did not dilute the shareholders, but they did
Mm,
raise a ton of debt.
yeah.
So we look at their balance sheet and we can see that there is a ton of debt in 2022, 21, 2022. But they've almost paid down, coming up to almost $1 billion of that debt already. I think their target was to get below 2 billion in debt in order to resume, or their leverage was 2-1, I think, to resume the buybacks. They met that, so they can resume their buyback plan. It's really a question for me of, you know, how long is their, I don't know, the demand for their product going to be? And some people are going to say that, hey, Crocs are going to go away. The trends are going to change. And I could see that totally, but I will say that even if the trends change and demand fluxes, um, they've already proven out that they're very, 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 very good from production and operation
Mhm.
efficiency wise.
Yeah.
So
Yeah.
when I talk about, like Cigna Health or PayPal being able to have that like higher margin so they can compress the competition and they can be the ones like really forcing down um, margins on the entire sector. Like, I don't know if a competitor could come in and compete with Crocs. I don't know if they could now. Um, assuming the demand is there for the
Yeah.
product. Well, like first off, the product is patented. The specific formula they use for their foam is patented, um, and they have a really really good marketing strategy. Um, I don't know. Like even if somebody wanted to compete with Crocs, I don't think they would be able to get to the margin levels that Crocs has very quickly.
No.
And it might make it to where it's a harder market to enter. And like that's, that's the other thing is like their gross margins are just disgusting. So not watch list overview, market cap. Let's go to the gross margins. So
Yeah.
their gross margins
That's,
before this acquisition were 61%, right?
yeah.
And
Yeah.
Heydu drastically compressed their top and bottom line margins, and it's starting to recover. But just from their Crocs clog line, that that product is dirt cheap to make, like dirt cheap. I think it's like under $4 or something like that to make a clog, and then they sell them for 30, 40. Like it's it's dirt cheap, and
Yep.
it's very easy for them to change the color, do something different for like a certain event, and
Hmm.
like encourage people to buy more. Like, did you guys see like there was like I think they made a limited time clog for the Barbie movie, and it sold out in like nothing.
Yeah.
So I I don't know. I don't know if maybe the trends do change and they see a regression and they see a decline, not even just slowing growth, but like a declining growth. If they just flatline from here, I mean, they're still producing so much cash flow at this point. 12.25% free cash flow yield, almost 11% net yield, 14% EBIT yield. So if they just like stopped growing, but their margins remain consistent, um, and they were just smart with returning capital to shareholder, you're still going to make a decent amount off of this. But there is definitely that risk that trends can change super quick. Um, that being said, Crocs has been around for how long? Like 15 years now. Like
Yeah.
it just seems like it never goes away. Oh,
Oh no, he's
oh
here.
no.
Gandar.
So would I buy? Okay, we'll go over kingdoms first.
Yeah.
Would you ever buy cybersecurity stock like Fortinet? Yeah, I would for sure. I don't know if I'd buy Fortinet though, but that's because I'm biased. Um, it's
There
because
goes
I'm
the movie
biased.
bus.
Sorry, buddy. It would have to be where Fortinet got like ridiculously cheap because
Called it.
just from the product line of Fortinet that I work with, it's not regarded as a very good product. So,
Oh. Oh. Okay. All
um,
right.
but it is the product line that I work with, um, is not like I don't think it's the main driver or like the main product that they have, right? So with Fortinet, I think you're going to be looking. I would have to look into more of their like um, security, like endpoint security type stuff, to get a better, I don't know, understanding or belief on what I think the valuation would actually be. But I'll just say from the equipment that I work with, there are much better players out there. and that makes me kind of on it.
I was gonna say that I thought that you'd be interested in Fortinet as soon as Kingdom like left and said it's trash. Because there's an interplay between you two. Like there's a system. One
Yeah,
type of investor leaves, the other type of investor enters.
exactly. Oh my gosh.
It's the way of the world.
Oh man. Okay, so
The ticker
Chelsea
looks
is
familiar, but I'm not.
and
I'm not 100%.
yeah, so PCTY, man, I am interested in that one. I am pretty interested in that one. It is getting to like what did we did the evaluation on it, right? And Andrew and I honestly I dumped in my watch list. What was it? No, I dumped Paycom in there. Why did I not put so Paycom I've got it as like $200. I started getting interested in it. Paylocity, I can't remember what that one was. I don't know.
Tree Fitty.
Tree Fitty. The price has been going down nicely, so let's remove this because that's just ridiculous. 1.5, and we'll do free cash flow yield at the rate. Man, they have got some great growth, dude. Jeez. Man, and they're a fairly small company, right? I want to say they're like under 10 billion. 10.89. Okay. Yeah, I mean it's a nice pullback. I'm definitely watching it, and honestly, it should be one that I get a little bit more conviction in, do a little bit more research into. I just like the thing that worries me about some of these companies, specifically in the payment space, is that they're all priced like at really, really, really high multiples. And if that entire sector ever got like re-rated a bit, then it could be kind of rough. Oh man, Paycom is better. I don't know, man. I don't know. Paycom was interesting as well.
All I can say with Paylocity is the ticker makes me think of Picatinny rails, which are, if you're a gun nerd, you know what that is. But yeah, that's all I got. That's all I got. Yeah.
Okay, so you think 30x free cash flow is high multiple for a software company? Okay, so like, all right, this is
margin of safety. There we go. I gave you
no. Okay, this is what I have a hard time with, because like I know that they should deserve a premium, right? I know that they should deserve a premium, but at the same time, it's like cash flow is cash flow. So like, why would you assign essentially a premium to a software company? Like, I know there's going to be difference structurally in the business that are way more advantageous to, like, say, another type of business, right? But let's say
pump it up. Pump it up.
You know, like Paylocity has like before the Hey Dude acquisition, Paylocity and Crocs almost had the same gross margins, and I think Crocs had better bottom line margins.
Damn.
Right? So buying, I'm just talking out loud. So paying a 30x free cash flow multiple for the sake of it being a software company, which they obviously are going to have like way better sticking, like a way better sticking rate, a way like lower churn rate, potentially than something like Crocs. But then like I look at Paylocity and then I look at like Crocs, and it's like Crocs is yielding like 12% to the bottom line, and it's trading at a PE of like 8, and like it's totally different companies, totally different industries. I just have a hard time being like, yeah, I'm good with that. I'm gonna spend 30x free cash flow. So now what it is, oh God. Yeah. So it's the free cash flow yield of Paylocity is 1.95%. Net yield is like 1.44, 1.28. Oh my God, man. It's just pricey, dude. I don't know.
For the memes, do it.
Oh, well, I'm glad you get it. I'm glad you get it because like that it's really the struggle. It is the struggle cuz like in my head it doesn't matter what company it is, like what sector it is. It's like how stable are the cash flows, what's the risk of the cash flows being interrupted, and like what are the cash flows uh trading at premium wise, and of course what is the growth that I'm expecting from the company, because Paylocity I think could have way better growth long term than something like Crocs, and that's what would get me to pay a lot higher multiple for Paylocity than something like Crocs. I don't think Crocs is going to continue to grow at like their bottom line at like 80% or whatever ridiculous amount it's been, but Paylocity I feel like they have a way longer runway to grow that revenue or grow their top line and hopefully expand their bottom line margins, while retaining a lot of their customers. So, like, if I, dun, 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 if I could get Paylocity around, like, maybe where it's yielding 3%, I mean, I would maybe, well, let's see. See, that's where I just don't know about the growth, man. I just don't know about the growth. Like, I really expect that.
Pump it up. Pump it up.
Can I really expect it?
Pump it.
25. What,
no,
do you have
like
Paylocity?
no, I don't. So like I don't have I don't have a like a long, short, or even neutral thesis on this. Like, so no thesis from me. But like what I'm getting at though is like as much as she gets dogged on and clowned on, like a market participant like a Kathy Wood, you'd be like, okay, there's the ceiling. let's work down from there.
Oh man.
I think we could all name some names and be like, all right, there's the floor. Let's work up from there.
I mean, okay, so like even that being said, even if I take their growth down, base case 15%, bottom line growth, 20% CAGR, ending multiple of 4.74%, yield, which I think would be, definitely doable. They're getting super interesting. Like it's basically at that base case. Yeah, I don't know. So I'm gonna have to look into this more, honestly.
Wait a second. When did this one get pitched by Andrew?
So Andrew pitched it to me, or pitched it on this channel a bit ago, a couple streams ago, I think.
Okay.
And then I think you pitched it maybe in Sense or on Capital Mindset, and I think you might be pitching it again.
All right, because I have a theory. I'll wait for you to wrap up on that.
Is it like after it goes down 25% from the date that Andrew pitches, it's a buy?
No. And I'm not like full disclosure. I don't think that Andrew's doing anything nefarious here. I call it the Gondar effect.
The Gondar.
Yeah. So whatever Andrew mentions that he likes or owns, and as soon as he mentions it, there are only two immediate near term futures: goes up or it like just craters.
Well, like, so man, so these are the type of opportunities where I'm like, man, if it does crater and it gets to the point where it's like, paying out an immediate, or their bottom line yield immediately is right now at like 4% or something like that. That's like, oh man, that's really tempting. But like, so for one, the market is expecting a lot of growth, right, over the next 5 years. If it gets that reasonable expectation of high growth, this could be a great entry, right? If there is a crack in that growth and this thing re-rates,
look out below.
That's when you're like, I'm down 40%. Crap. And that's what concerns me. Because let's see, what was it from peak to trough? It didn't actually go down a ton. Well, yeah, 47%. We're down about 36% from all-time highs.
Yep.
But if anything in that narrative changes, yeah, look out. Like, what was it? Paycom got destroyed because they missed, right? 290. It was over 300, right? Oh yeah.
Yep.
Oh yeah. Dang. So yeah. Imagine the multiples it was in 2021. I know, man. I know.
Andrew does have a
Yeah.
great
So
point. Just stop loss. Just let technology handle it.
stop loss. See,
yeah.
that's when you get like stopped out and then it rips like 200.
Yeah. Volatility's
Dang
like,
it.
screw you.
I mean, like, yeah. But no, it's interesting. It's very interesting right now. I've been keeping an eye on it, Andrew. I promise you. I am very interested in this one. And I'll be definitely watching your episode with Chit Chat Money.
You got to plug.
That will be really good. So it's the interesting thing about like trying to analyze stocks is like a lot of times I am more than open of saying like I have no idea about this industry or anything like that, and I don't think you necessarily need to be an expert in the industry, but it's very good to talk to experts in the industry. Not that you're gonna like believe everything they say, but just that you can get your perception about it. And then if you do that enough and you like follow enough companies within that industry, you'll eventually get a feel for like kind of your own conviction level for the industry as a whole, but also for the individual players within that sector. So, but yeah, it is interesting, man, and I am definitely keeping an eye on it. It would definitely probably be one of those where if I did take a position, I would keep it pretty small, just because this thing could be super volatile. And I try to, whenever I'm establishing a position, I will always want to like stagger it out to where I know I'm going to have enough capital on the sidelines that like if it does get into my like crazy bearish scenarios where I think it's just like a screaming deal, and nothing is really fundamentally changed, I've got that capital ready to go, right? So that's it's just kind of my style. But yeah, let's see. Cool. Timeout. I'm going to be back in like 2 seconds because I have to go grab my phone because I forgot it, and I should be getting a text message. So,
alrighty. So I'll just like react to stuff here. Yep. Andrew Marshall. Hey, you. Be sure to like, comment, and subscribe. Yeah, I see you over there. Don't think I don't notice you.
All right, I'm back.
I don't know if you heard any of that.
I did a little bit, yeah. And like he said, like and subscribe to the channel. If you have watched an entire hour and 14 minutes and you aren't subscribed, you are crazy. So,
and as always, none of this is financial advice. We're just two guys chopping it up on a Tuesday night. Yeah,
exactly. Exactly. Never financial advice here. Never.
I got your back. I got
Thank you, man. Thank you. Cool, man. I was gonna see if maybe we could go a little bit longer. I don't know if we can though. So let me
Oh, yeah.
let's
I was gonna
see.
say I'm free, but I know that you have life priorities, very important life priorities.
You know what? I try to keep them priorities, so
Yeah.
gotta be good. Well, let's leave it up to people watching. What's is there anything else you're just itching to look into or talk about right now? If
There was
not,
an older one
go
that Dan
the
had
older
for
one.
you. Yeah, Dan asked for you to pick a YOLO, but it was kind of up there.
Oh, oh, I think I saw that.
Yeah, it was Paylocity, Fortinet, or Carrier. You must YOLO one now. Choose wisely. I can't see it.
I haven't really looked into Carrier. What am
Yeah.
I? What am I yellowing? Am I like really? Well, it's funny because I'm like, well, I kind of want. I'm kind of the most interested in Paylocity out of all of those, which is like
you
probably the
you
highest risk one, right? So, uh,
you're betraying your exit liquidity brethren.
no, no. Give me exit liquidity. I don't think you want exit liquidity at
uh, it's another
the
SAS.
bottom.
I'm predicting it. It's another SAS.
Oh man.
I feel terrible. Like my feedback here has been like really minimal as far as like
No, no. We got
productive
to talk
stuff.
about
But
WWE. You know, that
yeah,
was the
yeah,
best.
yeah, yeah.
You know, and yeah,
IWG.L. The hell is
yeah.
this? The hell is this?
What exchange is that on? What the heck? I'm not even gonna show that on the screen.
OTC is my guess because it has the little period. It's either that or it's a pref because it has the period. But all right,
Oh, yep.
it's
OTC markets.
OTC headquartered in Switzerland, I guess. Assuming that
Yeah,
looking at
interesting.
it is okay. What do they even do? This is us getting trolled right
What
here. Like this is us doing like first steps of due
workspace?
diligence.
Is that it? Workspace? Is it like? Is it like a WeWork?
The WeCap.
A
Shout out
WeCap?
WeCap. Shout out WeCap. Not sponsored, but it could be.
Andrew, you want to jump on, man?
And yeah, as I say, just do it. It's a WeWork that runs well.
It's a hey, I got there, man. I got there. I can't stay on for much longer, Andrew, but if you want me to, I will I'll send you the link.
Wait, hey, you know what? Actually, you could outsource this to Andrew and myself. Like, just leave the
Yeah,
thing running.
I'll just
and-
leave the stream and
yeah,
you guys can just go for it.
yeah. Just for fun. Really give the people the value they want. Oh, darn.
Exactly. They don't want Jesse on Jesse's channel. They want freaking Andrew. Jeez. Come on. All right, man. I should be in your Discord messages, Andrew.
Andrew.
We've got 5 viewers after an hour 18. That's pretty good. That's pretty
Nice.
good.
And
I
shout
think
out
we
to the
got up to
people.
like almost 20 at one point. So we've
Very
only
nice.
bored so many people.
What did you say was like the highest amount that you've gotten so far for your
I
lives?
think
That you've seen?
23. I think I
Oh,
had
dang! Holy!
I think I had 23 live viewers during Echo's stream.
All right,
Something
so
like that.
Echoes brings it in, and I did okay. I held my own.
Hey, you did
with
pretty
you.
good, man.
Yeah. You
I
carried
mean,
me.
we all know that I'm the real issue here, right? So
No. There he is,
Andrew,
What's up, guys?
Andrew.
what's going on, man?
What's
Go
going on?
ahead.
Can you
Go
hear
ahead.
me?
Pump.
Yeah, we got you.
Okay. Yeah, you guys haven't like listened to me try to pump IWG for like the past like 3 months.
Look, sometimes I ignore you. Okay, like kidding. No, He's gone. No, I have heard about it. But honestly, OTC WeWork just doesn't
It's not
appeal
well.
to
It's
my.
it's not actually OTC. It's listed on the London Exchange.
Okay.
That's what I thought, because when I saw the
Yeah.
.L, I was like, that's
Yeah.
probably London Exchange.
Mhm. They're actually going
Yeah.
to list on the. They're talking about listing on the NYSE, so they're
Oh,
gonna
really?
they're gonna switch their listings. Yeah.
Okay.
So just like I'm gonna give you like the 2-second or like 2-minute pitch.
I-
Imagine
Go for it.
if WeWork, instead of like losing money and taking all the risk, what they do instead is they run on a royalty or franchise model. So
Mhm.
they don't take like how IWG, they own Regis. I don't know if you know that brand.
Mhm.
That's like their biggest one. There's a couple others they own, but basically, what they're moving to now is, instead of taking on the risk of actually like owning, like being on the lease, they just basically get royalty revenue from running your floors. So if you're like if you're a building in San Francisco that's got 2 floors that you can't get anyone to come into, you call up IWG and they're like, okay, yeah, basically we don't take any capital risk. So it's a capital lighter, like capital, there is no capital in the model. And then they basically run it for you. Now they do have some, or they do right now, a large part of their business is run similar to WeWork, except that they're profitable. And they're trading at like 13 times operating cash flow. And so they've actually gotten a decent bump recently. And right there, they just report, if you go to that presentation, I don't know if this can pull up on your end or not.
I believe.
I might be able to pull up international stocks. Let's see. Data load, maybe. I definitely should
Bismillah,
know.
illallah. Allah Akbar.
It's pulling up
No.
some of it, right?
Kinda. Yeah, it's getting some of
trying.
it.
So just really quickly, the interesting thing is they have an app like that's part of their business called Worka, that they're looking to spin off or sell. And the quotes they're getting for it is like around half their market cap. So like they can almost like dish out, like realize half their market cap in value, and they're trading a super low multiple. And so, like I said, they're transitioning from being like capital intensive to capital light models. Like that's all they're signing now. And they're signing like, so as those capital light models take off, because it takes like 18 months to fully get those up and running, their margins will improve, obviously. And right now, like, I just think they're really well positioned with WeWork going under. So I've been in these guys for a while. I can kind of go through like their whole thing. So actually, funnily enough, they were the WeWork of the 1999 bubble. Like they were around in 1999. So if you look, the CEO's been here for like 30, 40 years.
Nah.
He ran them, and the reason they're on the London Exchange is they were on the NYSE, but they went bankrupt back in 99 because they did exactly what WeWork did. And like the CEO is even quoted once saying like, we're watching what WeWork's doing, and they did everything we did in 99 before we went bankrupt. So like he's been around the block and knows this industry.
Yeah.
And I think he still owns like 30% of the company. You can probably hear my dog right
It's
now.
like, yeah, that's not gonna work, guys.
Yeah. And like he didn't say it in like a really like aggressive way. He was just kind of like, yeah, like that's kind of like what we did.
I have a
live and
question and
learn.
a quick. I have a question and a quick follow up.
Yeah.
But once you're done, once everyone else said their
No. I think that's like mostly it, really. I mean.
Oh, okay. All right.
Yeah.
So, my first question, and I want to strangle myself for thinking and saying it. Moat ?
Well, WeWork just went bankrupt, and these guys aren't going to. So I feel like
It's not a profitable
right.
industry, so
Let me-
that's their moat. They can
let me
actually
explain
be
myself.
profitable.
Let me explain myself for the viewing public. Like, all right, so I heard like capital, like less capital intensive, correct? Like, all right. So whenever I hear less capital intensive, I'm thinking to myself, all right, well, if we do care about some sort of moat or comparative advantage.
Okay, I see your question.
Yeah.
So the people have asked the CEO about this, and his answer has been like, running a building where you have long-term leases, like 5-7 years or whatever, and running a floor where you're trying to get people like daily, monthly, is completely different. Like the operational, like the execution is very different, how to run that. And so these big companies, these big like office buildings, they don't have that operational expertise on how to do that. And I don't think they're interested in trying to compete when they can just work with you.
Okay.
And then for them, it's a win-win. That's been the pitch by the CEO, and based on the number of signings they're having, I think that he's correct.
All right. And my go ahead.
I was gonna say, so they don't. I'm trying to wrap my head around the capital light structure. So they don't own any of the space, right? And they're not leasing the space.
Currently, they do own some. That's why they have some debt, but like they're basically all their growth is going to come from that, from not owning it. And so basically
they're just partnering with, and then they're basically opening up the spaces underneath, like other people. Are they like maybe like splitting a percentage of the
so they say they franchise it. Yeah, so one of the things they say is like franchising. Exactly. So
all right. All right. So
you know how like a franchise model works. You basically have some person who's okay taking like a worse business model, and then you get to get the royalty revenue for that. More or less. You know,
more or less. Yeah. All right.
And then are they also managing the space from an operational standpoint once they do the I don't know, whatever development in the move-in?
When you say set up operationally, you mean like no, even after it's set up, they're still like, that's what you're paying them for, is to be running it so that you're getting butts in the seats, you're getting people in your building. So they're still running the operations on that floor to make sure that people are using it.
Gotcha.
So yeah.
All right. My quick follow-up was so okay, right now I currently see it on the over the counter. And yes, London Exchange, but if or when they do get listed on New York Stock Exchange, what are the mechanics of all of that? Like with the over-the-counter shares, or is over-the-counter just not an issue, non-factor?
I don't think it's an issue. I think they just convert. Let me see if I can find the article.
Okay, alrighty. That was just like one of the like fun things that I wanted to ask. That maybe like there's nuance to that. Not everyone considers. And hi, hey Dan. Hey Dan. Hey Dan.
Hey Dan.
Yeah.
Hey Dan.
Let's see. Yeah, the article's pretty short, where he just basically says we're considering listing in the U.S., considering half of our businesses over half our businesses from the U.S., but it doesn't address any of like that. But I don't think it'd be any kind of issue.
Totally. Yeah. Alrighty. Okay. Yeah. Because it's always like fun and important to know like the mechanics of these things to figure out how you can get screwed over as the regular-ish person.
Yeah. I think Hayden, or not Hayden, I saw Hayden in the comments. I think Jesse's looking at a very important part, is the ESG.
Yes.
Very important.
That's what I was just going to say. Well, like the most important part of this entire business model is that they transition 28% of electricity to green certified generation.
Yeah.
So
carbon neutral since Jan 1.
That means that typically has a direct correlation with the KGAR you can expect over the next 5 years.
So you multiply the percentage of certified green electricity to the KGAR.
Exactly. But only in workspace stocks.
And if you guys, by the way, if you guys want to know, the way I found this stock was through this Twitter account that I follow, One Main Capital. I don't know if you guys know who that is, but
name rings a bell.
Pretty solid. Yeah,
what we
he's
should
an
do.
IWG, and I heard him talk about it, and I was like, this sounds really interesting. And you look and you're like, this company is really cheap.
That's interesting. I feel like we should sometime compile a list of either like people or content creators that are good resources just to watch. Like they actually put out decent recommendations or ideas, just to build kind of like a lineup of things to look out for. Because there's like
Yep.
it's so hard sometimes finding the people that are somewhat decent.
Right.
And there's so much noise out there that it's really hard to be like, if you look at a whole bunch of, Twitter accounts or different finance YouTubers or whoever, you might see 100 people and maybe only like 5 of them are actually like worth paying attention to.
What was I going to say? Yeah, I feel like as long as you follow the good ones, I'm trying to think I think off the top of my head, it'd be like Financial Education, Tom Nash, Meet
Oh dear
Kevin.
God, why? Why?
No, I'm just kidding.
I hate you so much.
But anyways, no, I just want to come on
Andre Jake.
Dude, I forgot that he still has a channel. Is he still?
You know what? Shout out to the Benjamin channel. Like, yeah.
For real though, an actual good one, I would say, to follow. And this isn't necessarily on like individual stocks, but if you're interested in like market sectors and stuff like that and portfolio management, Ben Felix has some pretty entertaining content,
Oh,
and
name rings a
interesting content. So, and Ben Felix also runs the Rational Reminder podcast, that is on basically just going over portfolio construction, different things about the stock market or equity markets, the economy. Like it's really interesting. I think he had like the co-founder of Vanguard on there on one episode that I listened
Very
to.
nice.
It's some pretty interesting content.
Oh.
There's some stuff that I agree with and don't agree with, but like it's definitely worth a listen.
Yeah. Well, and just to I just want to give that update energy. And actually, that's like the business model you're looking at right there. Like the investor, that slide you're on is kind of like the business model where you have like the building owners connects the IWG with the hybrid customers.
Yeah.
They're like the intermediary. Yep. And that's like I said, they just like run it so much better than we work. You can't run it worse. But
do you think this? I mean, I don't know about going forward, but like with the exodus out of office space, do you think that presented a lot of good opportunities to them previously?
No.
That maybe they might not have going forward if everybody's like returning to office. Like maybe because I'm thinking like if I was an office space owner and I was like, my office space was sitting empty, this would be a really good option, right? But as demand for office space potentially picks back up, do you think it might be harder to find these type of deals?
I think it is a headwind, but I personally still think there's going to be a lot of hybrid work still, and I think you will have a lot of companies that continue with hybrid work or shared space, things like that. And so I do think that there's like potentially a headwind, but I think overall the effect of COVID has been extremely beneficial for them. And so like, I think it's a net positive. The crazy thing to me is like, and I mean, I'd have to go back and look, but you think about how this hybrid workforce would be like positive for them and how good it would be. These guys are down still like 50% from their pre-COVID price. And that doesn't mean that they're a buy here, but I just find that interesting that like they never really cover for that. And I think part of it is that I think companies that are listed in the UK right now are super cheap.
Yeah, that's probably
probably
a good case. Yeah, geographic discount.
Yeah, so but that's the thing is they're listed in the UK, but more than 50% of their income comes from the US.
Oh no, don't get me wrong. Like one of the ones that I mentioned like way back when was Ferg PLC.
Mm-hmm.
Yeah, same concept there.
Yeah, but no, I just think it's really interesting. I'm like, I think today they're really cheap, but I'm actually getting excited by. Yeah, and I'll probably. I think we have my CM meeting tomorrow. I'll hop on after the other meeting I have, but it's really like I thought the And you can listen to the earnings call. It's really short. Like they always have really short earnings calls. I don't
Yeah.
think they're very well covered. But like management sounds super excited and like happy about how it's all going. So
Just out of curiosity, like when it comes to PLCs, have you noticed like a trend of nuance when it comes to corporate governance, or no?
what do you mean?
Like something that's very, very common from a corporate governance thing. That's like, you know what, this is very, very like common for PLCs. I don't know. Could
Not
no?
particularly.
Alrighty.
No, I mean, I also might just not be looking for that. So it could just be like
Yeah.
I haven't.
It's all good. It's all good.
Yeah. I think actually, let me just double check this. 'Cause I think did the CEO buy more shares? I'm curious. Not that that means anything by itself. I know people are using it like for a whole bull case on certain stocks, but I'm just looking at this.
If it's SAR or Phantom stock, please tell me so I can laugh and cry at the same time.
No, I think he. Let me see. I think he. Yeah, insider buying last 12 months, 1.7 million. Insider selling 0. So that's pretty solid.
And that was that like actual? Is this it? Oh yeah, shoot, $2.
That's less than $3.50.
Is that those insider buys? Is that actual like buys, or is that stock awards? Do you know?
I don't. I'm just looking at this now.
Yeah.
But if they got stock awards and held, that's still pretty positive. And usually, I'm assuming this is. Let me see if it's open market buy. Oh my gosh! When I try to open this, it gives me like a.
What source are you using, Andrew?
Well, normally I use Open Insider, but that's SEC Form 4, and that doesn't work for this. So I'm just going down Google.
I got
no. It looks like three open market buys from the CEO. One on 6/29, one on 10/13/22, one in September 22.
Yeah, I'm often like hesitant with Open Insider. Like I have mixed feelings with them.
Yeah, this is Market Beat that's showing this one.
Okay.
Yeah.
Okie dokie.
But anyways, I don't know. It's just another data point. I don't think it means anything. Anyways, I get back to
That'll be interesting. I feel like that is the business model to go though. If you want to do some type of WeWork type thing, like I think like owning the actual office space probably gives you too much risk for I don't know, doing a office space share. But if you're just able to capitalize on other people that can't rent out their office space, especially if you can go in and you can project demand correctly, and say, we expect to do X amount, do it for a couple of years and then renew the contract or whatever, that could be pretty beneficial. Because I do kind of agree with you that I feel like these flex office environments are going to probably gain popularity. I think there's going to be certain industries where they probably will never happen just because of potentially legal NDA, IP stuff. And that kind of bothers me with especially like larger tech companies. Because I think like the larger tech companies, they're just going to own their own space, or they're going to have a straight out lease. But for like the small businesses and stuff that just need their employees to have random access to that type of space, it could be really good.
Oh yeah, I mean, like the market here is not to get Google and Meta to sign with you, because there's a reason that Google and Meta have like 5-star chefs or whatever they have for their employees. It's because they don't want them going out to lunch with their friend that works at the tech firm down the street and talking about that. So that's never going to happen. But Yeah, no, I think there's still a massive market for this. And remember too, like it's not just US, right? So like they just signed a big deal with some company in France or something for like 200 locations. So like, you know, there's but anyways,
So what you're saying is it's
Go ahead.
it's the Tesla of flexible workspace.
Oh yeah. So
The Palantir.
they're not just a flex workspace company. You know, they're also an energy company, as you can see by them being ESG
Yes.
and
yes.
running energy efficient locations, and yeah, all
Their
that.
AI
I'm sure
robots
they'll
are
also break it
great
down.
too.
Someone, Steve B did point out, I want to say this before I go, is that they are less than $5. That means they're more risky, as a famous investor said. All stocks are risky. Stocks below $5 equals more risk. So be careful.
But
If you're not
what are
catching
they
the
actually
reference,
on
I'll
the
tell you.
London Stock Exchange though?
So there are 165
Oh no, I got
GBP,
it.
which I think that's like $1.65 essentially. So they're
Really?
still below $5. Yeah.
Dang.
Very sad.
Yeah,
But
I wonder.
everyone.
No, go ahead.
I was just gonna say, chat. I did it. I was able to squeeze out like a little bit north of an hour and 40 minutes from these guys.
All right.
Yep.
I do
And
gotta get going.
it's a negative market with the more talking heads that we have on screen. 3 people instead of just 2. Red day.
Oh, you have interactive brokers too?
Oh, don't be
that?
that impressed. Even I have interactive brokers.
No, but usually people get that because they want to buy international stocks.
Oh,
So
okay.
that's why.
Yeah, no, that's fair. That's fair.
I only got it to buy IWG.
That's such a meme.
I had it for a
Fidelity.
brief time, but man, I like Fidelity a lot more. So
Can you call Fidelity and do international trades?
I
Or
think
how do you?
so.
Because I've been considering moving it back to Fidelity and doing that, but
I could just buy OTC.
Wait,
dude,
what
the
about
OTC has no liquidity. I would not do that.
What about the 0% Fidelity?
Lose 10% on the spread.
Let me see what the I gotta find what's the OTC
I was gonna
ticker? IWGFF.
Oh.
Yeah, it's got a volume of like 30,000 a day. Good luck.
Oh, that's enough. Sure.
Yeah.
Oh my gosh. So, what was it? Let's see. Oh, I don't know. Whatever.
Yeah, but
we're too sidetracked now. But no, that's interesting, man. I'll have to look into it.
All right. Well, I'm gonna get going now, guys. Gotta get back to back to work. So.
Okay.
All right.
Boss has got me.
And with that,
so. You guys heading out?
Darn! I was so close. All right.
So close to what?
No, we just hit the 2-minute warning. I was thinking to myself, yeah, you know what? Maybe I could like squeeze out an hour and 45. All about giving the viewers the value.
Sorry.
No, it's all good. It's all good. You gotta go.
Well, have a good one, everyone.
Yep.
And yeah, we will see you in the next live stream in 1 week. Thanks, Bacon, for joining me. It was fun as always. Good discussion, good banter, and we will catch everybody in the next one. Bye.
Bye.